Hi, good afternoon and welcome. We were kind enough to be invited to TIPA last week to give the Northeast market update. And we thought it'd be great if we extended that privilege to an online recording, a podcast of sorts, where we can sit down and talk between the panelists and speak more about what we talked about last week in greater detail. Again, we're going to do this more podcast style, more conversational. It's not going to be your typical market update. We're up here lecturing. So hopefully the audience can get a little bit about this. So on the agenda for today, we're going to talk about regulatory first. We're going to touch on ISO New England and also New York, touching on things such as DASI, New York Tier 1s, and also some of the regulatory changes in this area. Then we're going to get into some environmental updates. That's going to be a lot about Northeast compliance, voluntary demand, things of that nature. And then finally, we'll get into a general market overview, where we talk about some of the fundamentals driving this market right now with a focus on capacity. So we did this live at the conference last week, but again, I have to read off a disclaimer before we start our discussion here officially. The views, opinions, and statements expressed by speakers during panel discussions, market updates, or any public forums are solely those of the individual speakers. These views are based on their personal experiences, expertise, and analysis, and do not necessarily represent the official position or views of SmartestEnergy US. While SmartestEnergy US strives to provide accurate and insightful information through such events, we encourage participants and stakeholders to exercise their own judgment and conduct independent research or analysis as needed. All right, gentlemen, now that we have that out of the way, we can get into some introductions. I think we start with who has the most tenure on this panel right now. And Seth, correct me if I'm wrong, I think you're coming on 20-year anniversary in the marketplace?
That's right, Mike. Hey, 20 years just about to the day. I think I had my first started my first role at an energy company in the summer of 2004. So happy to be here. Yeah, as Mike mentioned, I've spent most of my career in wholesale, mostly origination. So covering the wholesale transactions with munis, co-ops, and mostly generators. But I've done that at a couple different large like IPP marketers. And done that in a few different roles: origination, structuring, pricing, and risk management. I've been with Smartest for just about a year now. Again, building our relationships with generators and working on kind of structured generation transactions in the markets that we operate in.
Awesome. Thanks, Seth. I know we're both really excited to have you here. I'm privileged to be sitting with both of you. Ben, I know that we've only worked together for a short period so far, but I can already say you've been very transformative in the way we're looking at our RPS obligations and voluntary and things of that nature. Why don't you give the audience a little bit about yourself? Ben, you're muted.
Sure. Thanks, Mike. Sorry about that. I've been in the environmental commodities space for roughly 6 years now. I initially started my career with a proprietary trading firm that focused on the EU ETS cap and trade market. More recently moved to New York in the last 3 years, and here I've been focused on renewable energy certificates, cap and trade carbon in California, Washington, and RGGI. And I've recently started at Smartest in January.
Awesome. Again, thanks for being here. And I think that leaves me. I've been coming up on 17 years in the space, started up as a Northeast electricity broker, moved on to be an analyst, then finally head of operations, and now currently a channel partner manager here at SmartestEnergy. So again, I'm looking across the screens right now, and I feel very, very privileged and honored to be sitting here with both of you. So again, thank you both for your time. So I think we'll start off like we did last week and talk about regulatory. There's a lot of items that you see up here on the screen right now, and a lot of these are still pending. So I figured we start with the ones that are more actionable, and let's talk about DASI, or the Day Ahead Ancillary Scheduling Initiative. This is going to go live in March of 2025, and it's going to have an impact on the Northeast marketplace. What this program is going to do is bridge the gap between the day-ahead market and the load forecast. And this is becoming, you're going to see this theme probably in a couple of different items we're going to talk about today, but it's the evolving generation fleet we have and more renewable sources involved. And we can no longer do this on a seasonal way or an outsourced way. We have to be doing this on the daily. So again, I think this is going to be very important to reliability into New England. To give you some background, there's going to be two new ancillary programs that are going to come up out of this. There's going to be the Flexible Response Service, or the FRS, which is going to be your spinning reserves or your fast starts, but then also the Energy Imbalance Reserves, which is the EIR. And that is, again, going to allow some of these day-ahead bidders to perform above and beyond what they originally bid in. So, and what this is also going to do is replace the full reserve market, so the FRM. So you're going to see that be phased out and be replaced by this. And I can say that, this is one of the few items I've seen in recent changes in the marketplace that seems to be fully supported by the marketplace. So I think this is a good thing for liability. Again, goes live March 1st, 2025. So if you're not already aware of it, maybe a good time to start educating your clients on a potential change in law or potential change in the marketplace coming up in the very near future. Some of the impacts of DASI, we'll touch on that real quick. I'm not going to sit here and speculate in terms of what the final cost is going to be, because it's going to ultimately be a market settlement. So I'm not going to sit here and say it's going to be X higher. It's not a published rate such as that. So it's not as simple. So, what I can say towards it is, again, we're going to have more activity in the day-ahead market as a result of this. So naturally, we're going to see probably higher prices than day-ahead we've traditionally seen. And in the reverse, we're also going to see the real-time market not be used as much. So hopefully we're going to see that market start to tail off. So we're going to see this give and take. And then the final impact, which we already touched on, is, again, FRM is going to be completely removed from the process and be replaced by these mechanisms. Now, we had quite the talk, and it wasn't our panel talking about it, but we had New York regulatory on the agenda. And the largest item that was talked about was broker registration rules. And that was a very lively panel that went on before us. And we're not going to touch on that. We're not going to encroach on what they talked about. And we didn't live last week either. But again, if you haven't been talking about New York broker registration rules and you're curious about it, I'd highly encourage you to reach out to TIPA, talk to them about the latest and greatest, and potentially become a voice as part of this conversation. The one thing I will add is that there's other pending items that are still being discussed. We talked about price compares when it comes to New York billing, kind of some of what you've seen in New Jersey, where on the first page, you're going to see what you could have paid on utility versus what you're paying with the ESCO. And also there's going to be new supplier rules when it comes to renewal notifications. So those are some of the other agenda items that are being talked about that have yet to be finalized. But again, I think the most important here is talking about those New York broker rules.
Hey, Mike, quick question for you. It seems
Sure
like
thing.
I hear more about this every day. I think that in Maryland, they passed some pretty restrictive measures, I think, on competitive suppliers recently. And I think, a couple weeks ago, I recall seeing a headline about shopping customers in PICO spending, X hundreds of millions of dollars more than their peers in default supply. So I'm just curious why you think, there's so much after such a long period of time of, having, competitive shopping, why all these rules and restrictions showing up now?
That's a great question. And it's certainly a theme we've seen out there. You had mentioned Maryland. We've seen actions in New York. We've seen Connecticut. Let's not relive the Connecticut episode. I've got enough gray hairs to be talking about that one again. But it's a great bridge because we also have pending legislation in Massachusetts. So I'm glad you asked the question. So it's not finalized yet, and we'll see what the final looks like. But even Massachusetts is jumping on the bandwagon of talking about these new rules and where they come from. I think to start it off, you had asked why. And I think when you think about why these rules come about is you turn on 6 o'clock news and you see someone taking advantage of your grandmother, grandfather, whoever it might be, some class of people that are being taken advantage of. And I think it stems from there. And I think these rules and this motivation from the legislation is to, again, protect those classes of people. What happens, though, is that sometimes these rules are rushed out to market and they're not fully thought out through in terms of the wider impact of the marketplace. We've seen in New York, they're still going through back and forth. We're still talking about this. That was supposed to be finalized a couple of weeks ago, and we had another 90-day extension. So again, as they roll out these rules, it just creates more and more questions in terms of how do we adhere to these rules across the board, brokers, suppliers, customers. And I think it becomes more important. Touching on Massachusetts really quick, some of those rules that I had mentioned, they're talking about creating licensing fees of $10,000 and a $5 million bond, increased TPV verifications, changing complaints from 30 days to 2 years, unauthorized switching from $3,000 to $5,000. And I don't want it all to sound negative here. So here's some of the positives that they're talking about Massachusetts as well. They're talking about supplier consolidated billing, hopefully being a part of the mix, accelerated switching, and also some seamless move switching. So again, all this is starting from protection for the end user.
Thanks.
So I think that pretty much covers not environmental, regulatory. I think we can move on to environmental. I think it's a great bridge, Ben. If we start to talk about regulatory and things like that, we can certainly talk about New York Tier 1s as part of that in terms of a regulatory event coming up. So I'd love you to take the helm here and maybe talk a little bit about that.
Sure. The New York Tier 1 program is undergoing some regulatory changes. Historically, it's been a product that is a tradable instrument. So the New York Tier 1s were traded as unbundled RECs in the market. You can buy them from NYSERDA or other Tier 1 generators in the state. What it's changing to is a program where NYSERDA will be announcing the price of what they determine to be the fair value of a REC for the upcoming year. And based on the amount of load that an LSC provides, that will be what each LSC pays. And so it's a load-based program. It very much resembles what we currently have in place for the ZECs, so the zero emission credits. So it will effectively become an extension of that. Also in New York, what we've been seeing is the rollout of the EDP program, so the New York Voluntary Credit Program. It's relatively new, and we've started seeing some increased levels of trading. The RECs have been somewhere around the $16 to $17 mark per megawatt hour. And I'm sure as we start seeing increased levels of trading, that we'll also see increased levels of volatility. Also in New York, another fairly major update is Local Law 97 is approaching, and it has been announced that companies will be able to use RECs to offset a certain portion of their purchased electricity emissions. Right now, it seems as though they'll be relegated to RECs that are from Tier 4 projects. So these are projects that physically deliver power into New York City. There's also discussions around the use of ORECs, so offshore wind RECs. So those are the major updates that we've seen in New York. In NEPOOL, we've seen that they are currently phasing out the SREC 1s. Those will just become your typical Massachusetts Class 1s. Connecticut, we've seen some new voluntary guidelines. So moving forward, you'll no longer be able to use national greenie RECs, which is kind of the standard in most places in the country. You'll have to use RECs that are classified as NEPOOL Class 1s. So that obviously has a pretty significant impact on price. We're looking at $3 to $4 per megawatt hour on the U.S. national green ERECs, and with the Massachusetts Class 1s, I believe it's just over $40 right now on the spot market. So it may have a pretty considerable impact on voluntary buying within the state. The voluntary demand in the area, combined with just a general shortage of RECs, we've seen prices trade above the ACP, which has been quite interesting for both Massachusetts and Connecticut. It's unclear how long we'll stay there, but what we do know is that a significant amount of load-serving entities are now opting to pay the ACP rather than going out and purchasing the renewable energy certificates. So the market's been fairly tight for the last year and a bit, and there's no kind of there are no signs that indicate that prices will come off anytime soon.
Ben, let me ask you a question real quick before you move on. When we talk about trading above the ACP right now, you had mentioned we'll see what the trend does. For those of us not familiar, how often can that ACP change, and will it change because it's trading higher?
So it's unlikely that we see the ACPs increase. It does vary by state. Certain states are evaluating it. It doesn't seem as though that's an immediate option right now. There's some legislation being discussed, but I don't think at any serious or advanced level up to this point. So typically we'll see Democratic states pushing towards maybe increasing the ACP price as well. Republican states typically have a preference for lower ACPs. And so obviously a higher ACP means higher power pricing down the line for the end consumer. So it's not something that's necessarily popular at the political level. And so it's not it's often not a preferred route for those in charge.
And let me go back one further from you. So when we talk about the Tier 1 REC program, again, for those of us not familiar with it, as we talk about here on this call, do we know what those new rates will be come in 2025 when the new program kicks in and turns into more of that ZEC market?
No, those will be announced, I believe, at the end of December. So it'll be announced on an annual basis.
Perfect. Thank you so much. Sorry to cut you off. Please continue.
No worries. And we could get to the next slide. So part of what we think has been increasing prices, even at the compliance level, has been the continuation of voluntary buying. We see a lot of increased demand from data centers, especially in the Northeast region, and they're opting for renewable energy. And on top of that, they're often opting for RECs that are sourced at least state level, if not even more local level. And so that's combined with the fairly aggressive RPS programs have caused prices to go above the ACP. You can see here we've seen very quick increases in demand for REC buying in the last few years, and we don't expect that to slow down anytime soon. In addition, you can see here a larger portion of renewable energy certificate buying. So a lot of the growth effectively is coming from the voluntary market. So that's one from corporate commitments. So the Science-Based Targets Initiative, the RE100, GHG Protocol, they all up to this point have had a view of RECs that you can buy unbundled RECs, you can buy unbundled RECs at the national level, and that will count against your Scope 2 emissions. There are possible changes coming forward, but up until now, this has been the way that most companies that are signed up to these programs operate. Another factor that's been increasing demand quite a bit, we think, has been green hydrogen buyers. So for green hydrogen and for your associated tax credits to be valid, producers of green hydrogen need to buy 24-hour time-stamped RECs. And so what that's done is dried up a lot of the supply that's available, especially in Texas, but other places in the country, and made it more difficult to procure RECs, especially from facilities that are already doing that 24-hour time stamping in order to be able to participate in those programs. This has had a pretty significant impact on price. We're seeing the back of the curve trade close to $7. We haven't seen those types of prices since 2021, and they're there hasn't been any signs that this market is slowing down. So there's a lot of demand. People are still choosing to pay a little bit extra to show that they're committed to procuring renewable energy, and it'll be interesting to see what that does in the future market. On top of the unbundled rec buying that we've seen, we've also seen a lot of increased demand in the bundled PPA side of the market. So most of the big tech companies have, are probably buying anywhere between 10 and 50% of their total load with unbundled, but the remainder of that is usually done through either physical PPAs or virtual PPAs. So that's also contributed to a lot of the tightness in the market.
It's amazing to me, and I think when we were live last week, somebody had mentioned, looking at the diagram that's in front of us, that white area that you see on that chart, they were awfully surprised by what that data represented. So certainly some eye-popping numbers here and trends. The marketplace, it's amazing to me how much the voluntary is driving it right now. When we talk about the corporate commitments, we had talked about Connecticut, forcing their own rules of, hey, you can no longer buy national to fulfill this requirement. It has to be a local source. So, we're continuing to see this trend towards, again, voluntary being a much bigger driver. So I absolutely agree with you in that sense. So
Yeah,
I think,
absolutely.
so Ben, I think that covers all of your material for now, right?
Yes, that's about it.
Perfect. So I think we'll move on to Seth here, and Seth is going to cover, again, general market commentary. We had the pleasure of walking in last week right after one of the most volatile times in the marketplace, Seth. So I know you really enjoyed that. So why don't you take the helm here and walk us through some of the market conditions?
Yeah, sure. Thanks, Mike. So, just going to do a kind of brief overview of where prices are at now, and then kind of a deep dive on capacity. So, get started with kind of the current state of power prices in the Northeast. I've got 4 charts here, just showing different kind of contract durations. The chart on the top left is your summer, July, August peak power contract for both New York Zone J and Mass Hub. So you can see this is, and again, the window of time here is the last 3 months of trading. So, as soon as you kind of start to see, people sort of cement their views of like what the summer is going to look like, you start to see prices move around kind of, mid-May timeframe. So we've had a pretty good run up in general over the last couple months. I think a lot of that is driven by, pretty much kind of unanimous consensus, I think, that this is going to be just a warm summer. But in just the last week or so, we've definitely had some pullback, as we did have kind of a heat wave, that prior week, I think, before the discussion last week, where prices for the most part stayed, pretty stable. I think, PJM had their, highest peak load that they'd seen anytime in the last 3 years, and prices were, pretty benign for the most part. So I think all the ISOs managed to get through the heat wave, relatively unscathed. And so there's a bit of a sell-off in forwards after that happened.
Seth, do you mind if I stop you right there just to touch on that real quick? I think it's important to talk about that volatility for the summer, especially. Just going off the top of my head, I would say I haven't seen summer trade like this probably since maybe 2014. So it almost to me looks like it's trading almost more like a winter now than it is a summer. You can see from your charts you have here that we had this incredible run when we saw those forecasts and that heat. And then when LMPs don't perform the way they're supposed to, almost a total sell-off from where it was. So just amazing the amount of volatility here. Do you think that, I guess I know we're here talking about New York, but using PJM as maybe a sister marketplace, do you think that lack of performance there maybe dulls or mutes some of the volatility going forward?
It's a good question. I think there's a bit of fear kind of walking into every summer, I think. Relative to where things clear, I think people are they'd rather have bought and lost $10 or $20 a megawatt hour than stayed open at the risk of losing, a couple $100 a megawatt hour or something like that. I think one of the things I mentioned last week is that, every kind of year that we step into is a year where your supply stack has a little bit less flexibility, than it did the previous year due to, retirements of, gas units and peaking units, and a little bit more of that like uncontrollable intermittent wind and solar generation. And so I think people coming into these like periods of like, more extreme weather and potentially higher demand, there's just a bit of uncertainty about like, where we're going to start to see some maybe cracks in the supply stack as a result of that kind of trade-off that we keep making and exacerbating every year.
That's a fair point. Thank you for that. Sorry to interrupt. Please continue.
No, all good. I think the rest of these charts are, a lot less interesting to look at. So on the top right, we're just showing what the winter contracts are doing for this upcoming winter. In general, probably just like not enough information about, weather and actual kind of system dynamics to have like really strong views about what should be happening in the winter. So that's why you kind of see pretty stable price moves there. I think Algonquin sort of like trended up, Mass Hubs kind of trended up over time just as a result of Algonquin gas kind of moving up as well. And then the Cal 25 and Cal 26 are the bottom charts here, which have been like relatively flat again over this 3-month window, maybe up slightly. But if you look back to like 12 months ago, those contracts are still down versus where they were a year ago. So yeah, that's what's going on with the Northeast power prices. The slide here is just showing a couple of kind of, classic drivers of power prices in the area. So on the left, we're just looking at kind of the current state of gas storage inventory. The blue line is showing what actual natural gas storage levels are at any point in time. And then we have like the dark gray line, which is a 5-year average. And then the gray range is kind of like the min and max of, the 5-year storage. So you can see that, in the blue line here, we're trending above the 5 years. So a pretty good surplus in natural gas kind of going into the summer. And so that's sort of obviously, kind of a, that's if anything, that's like a bearish signal against, some of the anxiety about, the supply side changes or the weather that we talked about earlier.
Yeah, it amazes me when we look at it. It's almost counterintuitive, like you said. When we look at these storage levels, we're going at a very healthy level right now. It almost speaks to your point from the previous slide of that fear of it breaking. And when is this going to, just fall apart in terms of the generation fleet changing? My question to you would be, do you see us remaining at these elevated storage levels, or do you see us possibly eating into it more as we get through the summer, the winter? I mean, it sounds like almost we're baking in or an assumption that we're going to have a very hot summer and then potentially a very cold winter. That seems to be what's being priced into the electric market right now. Would you agree?
I mean, I think storage in general seems to be mostly weather dependent still. So a lot of the reason for the, kind of significant excess supply, that you can see sort of in that trough in March is a result of just having, one of the mildest winters on record in the area. And so we built up a big, kind of inventory there, and we've been kind of eating into it in some of the recent, weeks with the higher than average temperature. So I think it wouldn't take long to necessarily eat into that surplus if we had a, particularly hot summer or something like that.
It's amazing to me on our side when we're talking to clients or brokers out there. We've had so many mild winters now in a row. How many times can we keep, kind of passing that hurdle? I think that's the scary part right now, is that we have this, kind of expectation that we keep having these non-winters. But eventually we're going to get one. It's just a matter of when, it sounds like.
Yeah, especially as we, as like our natural gas supply and demand becomes more intertwined with, what's going on in Europe. I don't think Europe's had a really cold winter yet since the Russia-Ukraine stuff. So, there's a lot of things that could happen that we haven't necessarily seen yet in the last couple of years.
Looking at the weather, it looks like it's going to be a hot summer. What do you have to say about that?
Not much else to add here. I think the chart, the picture says it all. I think there's, again, pretty unanimous consensus that the whole country is just going to be warm this summer. So we'll see if that pans out that way or not.
I'll be curious to see, and this is more just a commentary more than looking for an answer, of how this increased storm season is going to be. I know we're supposed to have one of the more active seasons on record. So I'll be very curious to see how that plays into the weather forecasts and how it moves prices going forward.
Yeah, agreed. So yeah, I just wanted to spend a little bit extra time talking about capacity markets. Maybe not necessarily top of mind for buyers and suppliers and consumers, but I think there's a lot of changes in the market that are pretty interesting to follow. And I think where maybe in the past, hedging capacity may not have been, someone's most immediate concern. I think understanding how you're managing your capacity price risk going forward is something that you may want to pay more attention to than you have in the past. So I can talk a little bit about why I think that is. What's changing? It's mostly, stuff we know about, ambitious new clean energy targets, corporate demand, which Ben mentioned, unit retirements, and load growth as well. You hear a lot about, data center additions and the appetite for electricity that a lot of those things have. So all that is, I think, in my mind, kind of putting, capacity markets in the spotlight again. I think that really all ISOs are kind of facing similar issues, and they're all in various stages of addressing this through kind of market redesign and policy and stuff like that. So while you might not necessarily care about what's happening in MISO because your load is in New York, I think that knowing what MISO has gone through and how they've gotten there, and how New York, following in those same footsteps, what you might expect to see, I think can be very valuable. So like on the chart on the right here, I'm just showing what historical capacity prices have been across, a few different key locations in various ISOs. So, we've seen, for example, in New York City capacity in the last planning year clear pretty high as a result of winter, clearing probably closer to flat to summer, where normally a winter would clear closer to like rest of state. And that was due to some, retirements in New York City that caused that area to be a little bit more constrained. The big purple bar you see in the planning year 22-23, that's, the MISO Illinois capacity price, which cleared at the cost of new entry, cone, in that year. And then it's not on the chart, but the preceding year, Missouri in MISO cleared at cone as well. So there's been some volatility in capacity markets in MISO recently. PJM obviously doesn't show up here for a while because they've been delayed in their forward auction for a few years. I think we're expecting the next auction to happen in a few weeks. But generally, I think the consensus is that capacity markets in PJM should clear higher than they have in the last several years. And then you see that NEPOOL has been, pretty benign relative to history for the last several years, but there's some changes happening in NEPOOL as well that could impact that. So.
Yeah, I don't want to get ahead of ourselves on that topic just yet, but I will say it's interesting when we talk about New York and we talk about the resources coming online and what's being retired. I think we saw at least 2 sites in New York that had to be extended that were supposed to be retired, again, for reliability issues for a lot of the reasons you just mentioned. So I'll be curious to see if that trend continues, if we have to keep band-aiding this for longer periods of time based upon delays or demand growth in general.
I tend to agree. I think that will be the case. And there's some, I think the next chart's very interesting for that as well. But I think we'll see, potentially more RMR. Some of these units that want to leave are not going to. So whether it's they have to stay in the capacity market and their costs are higher, their marginal costs are higher, capacity costs clear higher, or there's kind of out of market RMR contracts for units like that, I certainly think that could happen. This is a snapshot of the interconnection queues for a few of the various ISOs. So this is incredible to me. But almost everything that's in the queue in all of these ISOs is wind, solar, and battery. There's virtually nothing that people are proposing to build in any of these ISOs that isn't one of those 3 technologies. So at some point in time, at least if you're taking today's interconnection queue as a proxy, everything is going to be replaced with, one of those technologies. So, we're putting a lot into, our grid basically being run by, wind, solar, and batteries.
I think when we sat there in New York, I think a lot of the commentary was surprised of how big the battery piece was in particular. And I think maybe it was you, Ben, that had spoken on that, just in terms of maybe it's easier to get a battery brought in, or it might have been you, Seth. I apologize. But I remember somebody talking about why batteries are a little bit easier to get approved and bring on board, but also there's limitations when it comes to that technology, right?
Yeah, I think that, someone did bring up a question about permitting, I think, an interconnection for batteries. And I'm not an expert on the interconnection process, but my just high level understanding is that the batteries are less taxing on the system. And a lot of times, actually, batteries are installed in places where there is transmission congestion. So batteries can be installed sort of in lieu of doing transmission upgrades in a lot of places. So at least from a theoretical perspective, batteries, in the right places should be easier to get through the interconnection and permitting process than other types of units. But whether the actual rules and policies of particular ISOs are actually, effectuating it in that way, is kind of remained to be seen. I bet they're not quite. So, I get that the number of requests in the queues are, many times greater than the peak load of the ISO in most cases. So there's tons of requests, and they're all kind of, again, wind, solar, and battery. A lot of the ISOs are struggling to process the number of requests in the queue. So, PJM has stopped taking new queue requests, and they've, I think most ISOs are moving to some kind of a process where they kind of batch process, a group of requests, and there's kind of periods of time where you submit requests, and then they process all those requests at the same time. So if you don't meet that first batch, then you have to kind of wait for the next season of interconnection evaluation. There's also, a lot of offshore here in New York and NEPOOL as well. So in addition to just the risk that these technologies present when they're replacing natural gas, for example, and the flexibility you have with other units, I think there's just a lot of uncertainty around when and if some of these things actually get built. We know a lot about some of the challenges that offshore has had so far.
And we saw it in New York with a couple, right, where we were supposed to have a couple coming on board and had to take a read out to bid. And again, it wasn't so much about the technology they're permitting; it was more about financials, right? And financing rates had changed, and that was a really driving factor. And they had to take a read out to bid in order to support the project. So again, it shows just how sensitive these things are, right, in terms of what can delay a project beyond what we can see.
Yeah, that's exactly right. Another one of the challenges I think that ISOs are faced with that is going to kind of ultimately find its way into capacity pricing is around it's referred to as resource accreditation. ELCC is effective load carrying capability, but it's essentially what it means is when you add a megawatt of wind or solar to the grid, how much reliability does that increment of that intermittent resource actually add to your system? And in almost all cases, it's a fraction of the nameplate capacity. And as you add more and more and more, that impact is diluted even more. So if you can imagine, as you add, solar's only going to generate in particular hours of the day. And eventually, as you just keep adding more and more solar to the grid, your peak hour shifts to some non-solar hour. And at that point, more solar is doing absolutely nothing for your reliability. So that's probably the simplest example I can come up with in terms of how, as you saturate the grid with more of these types of intermittent technologies, how their capacity contribution decreases. And so the ISOs use kind of stochastic modeling to kind of figure out how to assign reliability benefits to these units, which can, it kind of feels like they're experimenting a little bit. Each year they're kind of tweaking assumptions and trying to find like the right sweet spot for how to assign, reliability benefit to these types of units. So it feels like that's going to keep going on for a while in the future as well. On the chart on the right, I'm just kind of showing, in PJM, for example, how different types of units, how their capacity contribution has changed from one planning year to the next. So I think the most interesting example is like the purple one here, where in like planning year 23-24, a 4-hour battery would have had a capacity contribution for 1 megawatt of battery of like I think 83%. And then the next year it went up to 92%, and then the year after that down to 59%. So that's like the amount of, that's the volume that a generator has to sell and offer into the capacity market, and that affects every generator of that type in the ISO. So that can have like huge impacts on, what your supply stack looks like in the capacity market. Yeah, and then just really quickly, prompt year auctions are, I think, something that's a lot of people have been talking about, more particularly in PJM and in NEPOOL. MISO and New York have run like prompt year auctions for some time now. All that just means is when the auction, the period of time between when the auction is run and the delivery of the capacity is pretty small. Whereas like PJM and NEPOOL have historically run their auctions like 3 years ahead of time. And the view is that generally this results in higher costs to load because of the assumptions about what load is going to be in 3 years, and what your generation is going to be in 3 years is just so uncertain that they tend to end up overbuying capacity, and then they have to adjust for that in these like incremental auctions. And so I think there's more and more agreement that moving to like a prompt year style auction would be better in those markets. And I think certainly in NEPOOL, they've applied to FERC they have delayed their kind of next auction, and they're, I think, applying to delay it a further 2 years, so that essentially they're on a prompt year schedule. So I think what that means is for consumers and buyers in markets like PJM and NEPOOL, or particularly in this case in NEPOOL, where you've sort of been able to rely on the ISO to procure your capacity for at least the next 3 years. You always had price certainty with capacity for 3 years because of just the auction time frame. Now the ISO is only going to be buying for, say, like the next year, and so if you really want price certainty beyond that 1 year period, you need your supplier to offer a product like that. And in order for suppliers to offer a product like that, we need to see like bilateral capacity markets open up where maybe they don't exist today. So, some like an originator like myself would be going out and buying capacity from generators in NEPOOL to meet the needs of consumers who would like that kind of longer term price certainty that the ISO is no longer kind of facilitating.
It amazes me when I think it was a few charts back when we had looked at the capacity prices, what the future clearing prices are, and we talk about where New England ranked versus some other areas. It almost looks like it's barely on the map, right? So I was very surprised in terms of NEPOOL bringing this up now, while others seem to be a little behind. I mean, New York's already there, right? But we talk about PJM as kind of going through a similar process right now. It's been talked about forever, it seems like, and we're still talking about what it's going to look like going forward. But we keep moving towards seasonal auctions. Any thoughts in terms of why NEPOOL is choosing to do it now versus a wait and see approach?
Not really, other than I think they're just maybe being proactive, and like you kind of said, starting out. You can certainly learn from the experience of these other ISOs. So rather than wait until it's a problem, I think, getting ahead of it earlier is probably the right thing to do. So.
Yeah, we've already seen it in PJM, right? We saw Deep Hill and Duke recently, and some other areas where we're starting to see the cracks start to form. So, I would say if they're being proactive about it, and that's the thought process behind it, I would applaud them for that.
Yeah, I think there's still a big question in my mind about whether any of these capacity market constructs are going to get, new capacity built. I think most of the renewable stuff that is in the queue and that could get built, I feel like is ultimately going to need a long-term contract, whether that's a state subsidy or a corporate PPA or something. So I'm not sure if any of these market designs are incentive enough for a generator to just build a merchant project. So it'll be kind of interesting for me to see, how some of these things actually come to fruition, and whether, markets have to be even, redesigned more to, to provide stronger incentives for generators that aren't necessarily just going to get, kind of bilateral long-term contracts or state subsidized long-term contracts.
Yeah, we'll see how long this discussion takes this time. I can't imagine being in that position of having to make a decision such as that without knowing where the rules are going, because it's hard to want to come into the marketplace when you don't know what rules you're going to be playing by. So hopefully they come to an answer sooner than later.
Agreed.
So I believe that brought us to our end, and obviously we don't have a live crowd this time, but we're happy to take questions. I'm sure that our team is going to leave our contact information along with posting this video. So please feel free to reach out to us if you have any questions about any of the topics we covered here, or would like to talk more in depth about it, or talk to the Smartest team in general. So again, I want to thank everybody for their time today. Thank you, Ben. Thank you, Seth. I know you're both very busy trading within the marketplaces, so this is a premium to have you here, and I want to thank you for taking the time. And again, thank you to TIPA for having us last week. Again, we do that as a very important organization. Of course, with all the topics we're talking about right now, having their voice talk about such of the items that we're doing on behalf of our community is so important right now. So again, being active and being a part of TIPA, I think, is a key initiative here for our community. So again, thank you very much. And again, I hopefully maybe this is the first of many, gentlemen. Maybe I'll see you again on the next one.
Thank you, Mike.
Thanks, Mike.